Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for clicking. On this episode, we're going to talk about changes to the banking guidelines, things to anticipate moving forward with home equity lines of credits, and if you're planning on getting one, you don't want to miss this. Stay tuned. Hey, if you're watching this video on the Team Sessa YouTube real estate channel, thanks again for clicking, and thank you for all your comments and feedback. We appreciate everyone's feedback, and please make sure to leave those comments below. Don't forget to hit that like, share, and subscribe button, that notification bell, so you can get notified every time we post one of our videos. And if you'd like to book a free consultation with myself or Santo, you can do that in the description box below by clicking on the Calendly link, and we'll make ourselves available to have a conversation with you. But right now, back to the video. I want to start off this episode by having a little conversation about an existing client and a situation that was important to understand, as what we're seeing happening in the current marketplace is sort of unraveling at a rapid pace. And we're trying to find solutions for our clients to better assist them in financial goals and what they're looking to do. So we got a call a few weeks ago with a client that had a mortgage with a conventional top tier bank, and basically they had a very good rate, 2.89% on that product. And unfortunately, the circumstances had changed significantly, and they required to tap into some of their equity in order to cover some of their expenses that they had that had been incurred due to an illness in the family. And they had to send some money overseas to help the parents, some situations that were obviously important to cover. And the clients were looking to pay off some of those debts and make sure that everything worked out for them. However, what the client had experienced was that their credit had dropped significantly because of high utilization on their credit facilities. Now, the clients didn't have a line of credit. They were eligible for a line of credit with their product that they currently had, but unfortunately, due to the circumstances, they were declined by their bank. Actually, this worked out more beneficial for the clients, because if they were to restructure their product, because they were never issued a readvanceable, basically a home equity plan on their product. We'll get into that when we talk about some of the changes that are coming down the pipeline. But basically, we had to look at some solutions for the clients. Now, what we were able to do is look at one of our equity lenders on the B side and provide them with a line of credit that was feasible for them. Obviously, there are some costs associated with it, but the actual benefits outweighed the cost. Now, they didn't require that much money. I think it was about $80,000 to $100,000, which for some is a lot, but as I said, for these particular clients, it was just enough to get them where they needed to go. And they didn't have to exit their existing mortgage with their current lender at a very significantly low rate in comparison to what we see now. And the clients were very happy to stay there for an additional 2 years, ride out that rate, and then basically look at the option of using the line of credit and paying down that balance. So as opposed to restructuring everything at a higher rate, taking the larger mortgage balance, and then with the additional $50,000 to $100,000, adding that in and paying a larger rate of interest on the whole balance, we're better off keeping that balance at a lower rate and giving them a line of credit. Now, obviously this line of credit, as I mentioned, was from an equity lender, and it was a little bit higher than normal lines of credits available out there. But based on the client, as I said, their credit facility, their income had changed, and their circumstances had changed significantly, they were not eligible to qualify on that product with their existing lender. And luckily, they had a lot of equity into their home, and they were able to work with a product and a program that we were available to get for them. So obviously, this helped them not only get their debts paid off, lower their monthly expenses, increase their cash flow, but also will help them rebuild their credit. And it got us thinking to some of the changes that are coming down the pipeline. When you look at OSFI, which is the Office of the Superintendent of Financial Institutions, looking at the regulatory bodies, the underwriting practices that are happening currently with our banks and a lot of our institutions out there. OSFI is saying, look, remember the B20 rules, remember all these underwriting and policies and procedures to ensure that all the loans that are issued are underwritten at the highest integrity. It's reducing your exposure to downside risk. And obviously, when the markets are doing well, that's not a major concern as home prices come up. Obviously, that equity, that loan to value expands, but when prices tend to fall and home prices tend to come down a little bit, it can leave the banks, institutions, and lenders a little bit more exposed and vulnerable. Now, what's important to understand is obviously a lot of clients may say, well, that's the bank's problem, or let the bank deal with that. They're the ones that are responsible. Whatever the philosophy is, obviously we need the banks to issue money. That is how new credit is created. That's how that gets into the system, by creating mortgages. However, we need to make sure that the banks continue to lend, right? That is a major concern, and we don't want to run into a situation where the banks just stop lending, because that will create an entire new problem, a whole credit crunch, and basically looking at those institutions and if they stop lending. What we want to do is protect those institutions, and in turn, by protecting those institutions, we will continue to have a resilient real estate market. And that's what's important to understand, at least in my opinion. Obviously, I could be wrong, but basically when we look at the regulations, the stress test rules that were introduced in 2012 that were impacted in 2017 into 2018, with all mortgages now being stress tested. Here in Canada, obviously our regulatory bodies that govern all these types of transactions have done their job relatively well. Although we're seeing corrections happening now, obviously that is basically due to higher interest rates, what's happening with recessionary fears, inflation, and so on. These are major concerns. Obviously, we want to see some adjustment in these prices. We do want to make it more affordable for first-time home buyers to get into the market. But by introducing regulations and all these rules that are sort of put into place, yes, it sucks for first-time home buyers to get into the market, but it does help make sure that Canadians can afford the mortgages that they are getting into. So what did OSFI do? So sending a message to the lenders to be a little bit more extra safe, that was basically to avoid riskier mortgages and loan to values, or LTVs is what we call them, due to reduced home prices, which can leave lenders more exposed to downside risk and leverage. So that's basically what came out a few weeks ago from OSFI, and we saw them have this conversation. So why is loan to value so important? Or, how does it work? For example, if you purchased a home for $1 million, and you put 20% down, which is $200,000. Let's say you have a mortgage of $800,000. Basically, that is a 80% loan to value, which means you've put down 20%, the bank is financing the other 80%. So what happens, the LTVs of your mortgage would be around 80%. If you paid off more of the principal and the home prices continue to rise, the loan to value would fall. So basically, let's say the home value went up, that means your loan to value would not be 80% anymore, it might be 70% as you pay down that mortgage and the asset price continues to rise. Contrary to that is what we're seeing happening maybe right now. Obviously, with home prices and sales down 41%, we're concerned with the loan to value. So if the home that you bought for $1 million and you have an $800,000 mortgage, let's say it's now only worth $9,000, now you're looking at a different loan to value, and that is leaving the lender a little bit more exposed. And potentially, if your payments are not keeping up with the actual interest that's on it, we talked about that when you look at some of those variable versus adjustable rate mortgages, and some of these things in combined, you may run yourself into a situation where you might be 100% levered. Now, obviously, no Canadian wants to be in a situation where their home is worth less than what they're paying for their mortgage. And that is why some of these regulations and some of these institutions are basically changing their guidelines to make sure that we do not have all this risk in the system. So just to recap a little bit, what are the B20 guidelines? In 2012, OSFI introduced residential mortgage and underwriting practices and procedure guidelines set out as the B20. Now, this basically set strong expectations for lenders and residential mortgage underwriting for federally regulated lenders, right? So your major institutions, all your top chartered banks, as well as your mono banks, and obviously even some of our equity and B banks. Now, private lenders are usually exempt from this type of system, though some of them may follow it. Obviously, they have different guidelines, and FSRA is looking to challenge that as well and make sure that Canadians who enter into these private mortgages are not exposed, and obviously a lot more transparency. And that is a whole different topic for a whole nother video. Back to our underwriting guidelines. The original guidelines were mostly principle-based and included an exception that lenders would stress test borrowers for adverse conditions. So prior to the stress test rule being applied to all mortgages in 2018, only certain mortgages were being stress tested, and those were the variable rate mortgages, and obviously those rates changed and fluctuated with the average or medium of the most banks posted rate, actually, I should say. Now it's basically regulated by OSFI and not the banks. In 2016, OSFI reminded lenders about underwriting expectations in the form of a public letter. And when OSFI continued to see examples of relaxed mortgage underwriting at some lenders, they issued an update to guidelines to B20 And in 2017 came into effect our 2018 stress test rules. So what's happening with the regulators is as they see some adverse conditions coming down the pipeline, they're going to send out a warning, and then maybe they'll do a public letter as they did back in 2016, basically informing lenders of better practices and to ensure resilience in the lending and financing markets when it comes to regulated lenders. So to ensure that the entire system stays sound and we don't run into complications in the future. For my opinion, much like what happened in the US in 2008, Canada did not experience the same level or magnitude in the housing market as the US did. That is up for debate. Let me know in the comment section below if you agree or disagree with me on that comment. Now, basically, what is happening? What are some of the changes that we're seeing? And obviously, it's very important to understand that these products that we're talking about with changes to home equity lines of credits are for the majority of impacting Canadians that have what's called a CLP or a readvanceable mortgage and combined loan plans. That's basically CLP, combined loan plans. Most of them know as a readvanceable mortgage. I believe if, for example, I'll throw out some terms. If you're with TD, it's called the Flex Line. If you're with Scotia, it's called the STEP product, the Scotia Total Equity Plan. And that's the product that I have. And obviously, we can talk about how that works. With lines of credits, let's say you had a home that was free and clear, and let's say it was worth $1 million and you wanted to get a line of credit on that property, the maximum amount that you would be able to get on that line of credit would be 65% or $650,000. And that is without a mortgage. But generally what's happening with the readvanceable or combined loan programs is if there is a mortgage component attached to that, you're able to go up to 80% loan to value, which means you can go up to $800,000 and combine it with a line of credit. So if you wanted to have, let's say, $500,000 mortgage and let's say $100,000 line of credit, as long as it does not exceed 80% combined, you were okay. And this is sort of where the changes are coming in right now with these combined loan programs, where if your loan to value is at, let's say, 80%, and as you pay down that mortgage, and as we talked about, as the loan to value goes up with home prices increasing, you're able to tap into that equity or that difference. And some of these products are readvanceable in the sense that you just walk into your institution, you walk into your branch, say, hey, look, I have the STEP product, for example. My mortgage is X. I'm registered at Y. I want to access that difference. And some of them will see that on their mortgage statements. So they're able to access those funds. But for some Canadians who are at 80%, maybe they pay down their mortgages to 70% loan to value. If they're looking to get that line of credit, if it's not at 65%, if it's at 65% or greater, I should say, then they may be required to have a principal and interest payment attached to that line of credit coming down in the next fiscal years. Some lenders may have already adopted this. Some lenders are positioning themselves for this. So that is something to be prepared for if you're looking to get a line of credit and you're anticipating only to pay interest on it. Now, why would you only want to pay interest only? Obviously, it comes down to the conversation about what you're using the line of credit for. And this is a very important conversation that we're having with our clients out there to say, look, if you're planning to use that line of credit for something that you're going to keep that balance on that line of credit for an extended period of time, then it doesn't make sense to keep on line of credit. You may want to look at adding it to your mortgage, as that will generally be a lower rate of interest, even on a variable, because basically the line of credits, all home equity lines of credits, except for a few of them on the B side, are all based on adjustable and variable rate mortgages, meaning your prime rate plus, not minus, right? So, or at prime, depending on the size of that line of credit. So obviously this is a major concern. It shouldn't impact many Canadians, but obviously Canadians who are looking to go out there and get a line of credit. And if it's over the 65% loan to value mark, the main objective is for clients to understand that, look, while values are still relatively elevated, and even though they're coming down, for some Canadians who may require a line of credit for, if they think the recession is coming, maybe their job security is not as, they're not able to think about their job, maybe they're going to lose that job, or maybe there's certain aspects, for a family, maybe you're having, you're expecting and the situation may change. Obviously, understanding your finances situation is important, right? To understand where you're going to go with this line of credit. Obviously, we don't want our clients to go out there and buy vehicles, put all that money, go to the casino and put it on red. You want to basically make sure that you're using a line of credit effectively and for the right reasons. If so, it will basically help you. If you don't use it the right way and you're just basically subsidizing your entire lifestyle in order to keep up with the Joneses, you're going to find yourself in a very precarious situation relatively soon. The whole idea, as I said, with what we talked about last week, in our video talking about potential recessions is the government and the Bank of Canada want Canadians to stop using their homes as ATM machines. Obviously, anything that is above the 65% needs to be, a clear date on when it will be repaid. So that's sort of what we're talking about when they're looking at attaching these payments. For Canadians who have, let's say, a line of credit already at 65% and they're paying the interest only, hey, they're coming out saying, listen, you can do all you want right now with that line of credit. If you want to pay interest only till the cows come home, go ahead and do that. But if you're over the 65%, between that 65 and 80%, that's where they're going to want to have sort of a term, an amortization, a payment that requires you to pay interest and principal, not just interest only. And obviously some of these changes that OSFI has come to basically put down in writing or sort of firing these warning shots also applies to reverse mortgages and to basically equity share programs like the first time home buyers incentive. And I won't even get into the first time home buyers incentive because I think that program was absolutely a colossal failure. But just to keep in mind, the bank and the government, I should say, actually changed some of their requirements on the loss provisions of that program. Reverse mortgages, something that we can do another video on, is very important, but they're basically saying, hey, we can't exceed 65% loan to value. And for many, or for the two major players in the reverse mortgage space, none of them have actually gone over the 65%. They're actually pretty conservative on that amount, and it's usually around 55% loan to value. Obviously there's a lot of moving parts, and if you have questions about your mortgage, and if you enjoy content like this and you find it interesting, please make sure to hit the like, share, and subscribe button. Hit that notification bell so you get notified every single time we post a video. But we want to leave the video here. If you have any questions, always feel free to reach out to us here at InTouch Mortgage Solutions. We'll be more than happy to answer and field those questions for you. Until next week, have a great Friday and an even better weekend ahead. Thanks for clicking, and we'll see you next week.